Welcome back. I'm Jeremy Szafron. Well, gold is holding above $3,300 an ounce. Bitcoin recently broke $120,000, and the United States is running a deficit of over 7% of GDP, levels we haven't seen since World War II. Now, but at the same time, there's no bond push, there's no surpluses coming, and no political appetite to tighten spending. What we're seeing is full-blown fiscal dominance, where deficits and debt service now steer the entire macro picture. The Fed still talks rates and inflation, but markets are watching liquidity. Capital is rotating into hard assets, decentralized networks, and now even crypto-native Treasury strategies. Meanwhile, in Washington, a high-stakes crypto bill is back on the table. President Trump says he has the votes. Critics say it opens up the door to backdoor CBDC frameworks, and the news is moving fast, and so is Capital. Lyn Alden is one of the few macro thinkers tracking all of this in real time, from the structural risks in U.S. finances to new liquidity flows, reshaping Bitcoin, stablecoin, and allocation strategy. She joins me now. Lyn, welcome back to Kitco News. Great to see you.
Thanks for having me. Happy to be back.
Of course. Okay, we were talking a little bit before camera. There's lots to get into the news, so I don't want to age this interview too much. So maybe let's zoom out and start with the bigger picture. You know, you've long argued that we are in an era of fiscal dominance where deficits, not central banks, drive the macro cycle. But, you know, we've been hearing that for years. You know, what makes this moment different? I mean, deficits are now, as I mentioned, 7% of GDP. Interest rates are eating away at the budget here, and markets seemed unfazed. So what's the actual trigger here, Lyn?
So a couple of things are different from the prior trend. One is that demographics has finally kind of come to be realized in financial activity. So rather than just a theoretical issue in the future, it's now in the present, meaning that Social Security trust in the U.S. is drawing down, gradually spending more back into the economy than it's sucking out of it. And then two is that interest rates have ended basically a 40-year decline from very high Volcker levels all the way to zero on the short end and nearly zero on the long end of the curve during the bottom of the pandemic yields. And so for many decades, we had rising debt as a percentage of GDP, but we had falling interest expense. And therefore, the aggregate interest expense by the government was a pretty manageable share of GDP. But now we no longer have that offset. And so a lot of these kind of structural issues are now actually getting to a point where the debt and the deficits actually matter. And there's a couple other crossover points that matter. For example, the total amount of public debt issued on net in a given year now generally exceeds what we see in the private sector. So if you add all net new bank loan creation, and then you even add net new corporate bond issuance to that, that's now generally a smaller figure in most years than the deficit. And so I would say generally we've entered a period of fiscal dominance more so than monetary dominance, which is kind of classified the last 40 years. And so it's a different economic environment, and it's a different investing environment than many people are used to within their lifetimes.
Yeah, and when we talk about that, I mean, obviously we saw CPI, PPI came out this week, and then of course we got these tariff, distortions. I mean, the latest PPI came in flat, service costs fell, but CPI remained above 3%, and then core inflation is obviously proving sticky. You noted, I mean, I was on your X this morning, you noted that PPI excludes imports while CPI doesn't. And with this new Trump-era tariff now affecting goods from copper to appliances, inflation is leaking kind of in where it's not always measured. Are we underestimating the true cost pressures here?
I think not yet. I think there's still a lot of theory about how much and what time frame this is going to pressure things, because there's a couple things to keep in mind. One is that a lot of importers front-ran tariffs, especially in quarter one, by pulling in as much as possible. And so that distorted Q1 GDP numbers, but it did stock up inventories. And then two, some of these deadlines keep getting delayed or pushed around. And so even in this latest round, there's still kind of a time delay. And so I think that this generally takes months to start trickling out. In addition, there's no significant increase in the money supply during this period. And so what that generally means is that if there's higher prices somewhere, you're probably going to see either lower prices or just generally less volumes, which will contribute to lower prices elsewhere. And so that's different than, say, a stimulus type of inflation or a rapid bank lending type of inflation. That's more of a sector-specific type of inflation. And so I think it shows up generally more in unusual economic activity and potentially weaker asset prices than it does just in consumer price inflation.
Yeah. Has anything surprised you about this latest data that we've been seeing? I mean, it feels like it's been front run, but I wonder about Q3, Q4.
I would say nothing's particularly surprising about the data itself, just because we've had so many false starts,
Yeah.
delays, stops, things like that. So far, the magnitude on the ground is not massive. I mean, it's material in the sense that we generally see, a multi-hundred-billion-dollar annualized new tariff revenue. But when that's got like a two handle on it, so when we're talking about 200 billion in new revenue, that's pretty small relative to like 2 trillion in deficits. If you kind
Yeah.
of round it and say the government spends 7 trillion a year and takes in 5 trillion, if you add 200 billion, it's not that it's immaterial, but it's not really a game changer. The latest round of tariff letters that have gone out,
Hmm.
if they were all to be believed and enacted and then sustained, that would be something more like an $800 billion
Right.
tariff revenue stream, which I would argue would be very material. Um, and so I think that still is a market risk. And one thing I'm kind of observing is that back in the April kind of earlier round of tariffs, there were market events, and generally speaking, you had a backing off from the administration, delaying some of these things.
Hmm.
Now we're seeing that kind of the second round of tariffs potentially go in. The market seems to be trying to see through it and say, well, probably these will get pushed back or negotiated, or this is kind of a strong opening volley for negotiations. I think one of the challenges is that if you don't have a market event, meaning that prices stay relatively elevated, there's not an extra kick of volatility or prices going down, then generally speaking, why would the president back down from his very strong negotiating stance?
Yeah.
So it might very well take some sort of dislocation again to get some of the reprieve that the market seems to already be pricing in.
Interesting. Okay, that's interesting to think about. I mean, you warned obviously higher that these interest rates make the deficit worse, not better, because of the growing federal interest expense. Does this mean that the Fed has lost control of inflation expectations, or is it monetary policy now being boxed in by these structural fiscal obligations?
So I think loss control is perhaps too strong of a word, but I think
Yeah.
that the Fed's tools are much diminished compared to what they were before. And the reason for that, this is sometimes hard to phrase concisely, but basically back, for example, in the 70s, you had low public debt to GDP, and most of the money creation was from bank lending because the baby
Hmm.
boomers were entering their home buying years, which was peak credit formation in a lifetime. So you had above target, above trend bank loan creation, and federal debt to GDP is pretty low. So if you want to slow that down, which is what Volcker wanted to do, he jacked up interest rates super high, and what that did was that generally slowed down bank lending. It made borrowing less attractive. Slowed down the rate of money creation through the lending channel. Now it did blow out fiscal deficits because suddenly
Hmm.
the federal interest expense was much higher, but because that was a low stock of existing debt to GDP, the general trend was that you slow down bank lending more than you blew out the deficit. So you did have a net slowing effect on total credit creation. You also, and this is the part that's less talked about, you strengthen the dollar rapidly and you basically impair various emerging markets that were dollar denominated and therefore make them less able to consume things like oil. And basically impair the supply demand balance for some key commodities, which left more for the U.S. But that's the third thing that's not really often discussed. But going back to that kind of credit creation channel, the problem now is that if you have very high public debt to GDP, like let's say over 100% relative to the
Hmm.
35% that it was back in Volcker's time, when you raise interest rates to try to slow down bank lending, there's two issues. One, bank lending is not above trend right now. Excessive bank lending was not to blame for the inflation we saw in recent years. And two, when you do raise interest rates, you increase the federal deficit now at a faster total amount than you slow down bank lending. So basically, what that means is that the Fed's tools for slowing down total credit creation don't really work anymore.
Hmm.
Now it doesn't mean that they don't have any levers. It just means those levers kind of work differently. They have more of a lag. They're not as powerful anymore. And I think that's the new environment that we're in.
Yeah, you were talking a little bit about market risk there just before, and it kind of is on theme here because, of course, we got the Fed independence kind of being questioned too. There's this growing speculation that President Trump could move to replace Jerome Powell before his term expires. I mean, I think you put it out on X. Betting markets are pricing in rising odds, and we've seen reports that the GOP lawmakers have already discussed potential successors. Although this morning, as I said, hard to keep up with the pace of the news. But Trump did say on Bloomberg that he's not looking at this. Now, if a sitting president does remove a Fed chair midterm, especially over policy disagreements, what does this mean for market confidence and central bank independence? But more importantly, how should investors think about political risk as a major macro driver now going forward?
Well, that's generally something you see more in like emerging markets.
Yeah.
That's some of the commentary you saw on social media. This could be considered a trial balloon. Basically, they put out a lot of headlines from directly from the White House and officials saying that they were maybe going to do this. Poly market odds spiked to something like 35%. At the same time, there was a pretty rapid, not a very large one, but a pretty rapid drop in the dollar index.
Hmm.
And there was a drop in stocks and the long end of the Treasury curve, meaning that yields went up. That's generally not a successful trial balloon. If they had announced this news and the dollar was firm and yields went down, which is kind of what they want, then they might have. It's possible they would have gone through with the attempt. But because the trial balloon was basically saying that you kind of get the emerging market effect on your assets if you do this, it could have affected their decision. Hard to say either way what the counterfactual would have been.
Yeah.
Um, there's also legal questions. I mean, do they want that legal fight? Because the chairman can be removed with cause, and whenever you have a legal term like with cause, that's going to be debated if there was cause. So that could be a protracted fight that could be distracting from other things. So my base case is they won't remove him, but as headlines have kind of shown, it's certainly a possibility. The market's already shown what it thinks of it whenever these headlines flare up.
Yeah, yeah, it's just fascinating to watch. I had to get your opinion on that before we get into bonds because there seems to be this kind of rotation taking place. I mean, you've written that deficits don't break things like a light switch, more like a dial turning slowly. In 2025, I mean, how should investors think about their allocation to long-term treasuries, short-term cash, and real assets in this environment?
So I still generally don't view long end treasuries as particularly compelling.
Yeah.
I don't think they'll do as poorly as they did over the past 5 years. So I've been a noted bond bear, starting from the time when yields were very low and there were 18 trillion negative yielding bonds out there at the time.
Hmm.
That major washout is probably behind us now. But generally speaking, with long duration bonds, treasuries, you're going to get volatility without a lot of return potential. So while they might be useful for a trade now and then, they don't trade the way they did during monetary dominance. And in general, they're just not that attractive compared to scarce assets. If
Hmm.
someone wants a lower volatility asset, I do think that T-bills or other types of cash equivalents are interesting, especially if you expect, kind of intermediate term periods of volatility. So, for example, we talked before this very large in wave of tariffs. Generally speaking, you probably need to see some sort of market event
Hmm.
to have some of them be pared back. So if someone wanted to make that trade for 6 months, then raising cash is probably not a bad idea. But in general, over the multi-year long term, my opinion is you want to be in relatively scarce assets. That's high quality equities, that's gold, that's Bitcoin, certain real estate that's not overpriced, and generally you also want to find entities that can short the currency. I mean, part
Hmm.
of what makes corporate equities attractive is they've issued like 20-year bonds at 2 or 3%. So they're basically right along with you, shorting the currency and then owning better assets. Same thing for some of these Bitcoin companies like MicroStrategy that have taken out like zero coupon convertibles,
Hmm.
buy Bitcoin with it, and have like 5-year durations on it to give them a lot of runway. So those types of strategies I think continue to make sense in this environment. I generally like the short end of the curve more than the longer end, just in terms of risk reward.
Yeah, I mean, obviously you went viral for your time on the stage over at the Bitcoin 2025 conference. I brought it up in some of my interviews here, Lyn, and everybody, including, I mean, we had Ricardo Salinas over from Mexico. All these people know who you are, and they were excited about your talk. And of course, there you said Bitcoin was mathematically capped and fundamentally different from a Ponzi-like fiscal regime. I mean, obviously we're a Kitco audience, but I got to ask you because what makes Bitcoin an effective hedge right now, and does it complement or kind of compete with gold?
I generally use hedge more sparingly because hedge protects you in a very specific environment. So if you're worried about
Right.
stocks going down, you buy puts, which is a hedge.
Hmm.
Um, Bitcoin and even gold are not necessarily CPI hedges because if you get a spike in CPI, you're more likely to get a hawkish central bank, which is generally not always great for scarce assets, at least temporarily. What I generally view it as, it's protection against long-term monetary debasement. So as currencies, the supply of currencies keep going up, you generally want to own scarcer things. And then in for the scarcer things you own, you want to own best in class. So you want to own the
Mhm.
best equities rather than the worst equities. You want to own the best commodities rather than the worst commodities. For the best commodities, generally speaking, that's gold. That's the lowest stock to flow ratio. That's the one with the most monetary premium. Bitcoin is the best in class for digital assets. It's got by far the biggest network effect, the most security, the most simple and robust design, the best kind of uh, structure to maintain its long-term decentralization. To answer your question, I don't view it too much as competition for gold for a couple of reasons. One is I think that there's room for both of them.
Yeah.
Two, so far there's been different buyers. So central banks have been really, sizable buyers of gold as of late. Bitcoin is more like corporate buyers this cycle, to some extent, retail buyers. Um, and the East is more active in gold markets, and the West is more active in Bitcoin markets, at least in this current cycle. So I don't view them as too much in competition. In addition, gold is much lower volatility. It's about 10 times larger of a market based on most estimates if you look at like the World Gold Council. Now we
Hmm.
can we can audit the full supply of Bitcoin and know it down to the decimal point. We can't audit the full supply of gold, so we have to rely on estimates. But generally speaking, gold's about 10 times bigger. Obviously has a much longer track record. Where I would say that Bitcoin somewhat competes with is other precious metals exposures, generally the higher volatility ones. So historically, if someone was bullish on precious metals,
Hmm.
gold would be like the lower volatility one you might never sell. Whereas like silver, platinum, gold miners, these types of ones were generally considered more volatile plays on that trend. I'd say to some extent they do compete with Bitcoin and maybe to some extent broader crypto, which is you have these more volatile non-fiat currency assets uh, that now kind of fractures the liquidity to
Hmm.
some extent, where buyers have more choices than they used to. So I do think that Bitcoin to some extent competes with that, but less so with gold,
Right.
at least anywhere in this cycle.
But are you seeing them come together here in any way? I mean, the Bitcoin crowd and the gold crowd, it seems like they're starting to understand debasement a little bit better here.
Yeah, I think all these trends support both Bitcoin and gold. I've been long both for many years.
Yeah.
The way I generally phrase it is if you start with a 60-40 portfolio, you might want to consider replacing some of your bonds with gold, and you might want to consider replacing some of your equities with Bitcoin. Because you're talking about different levels of volatility of the assets,
Right.
and that's so far been a great trade. Bitcoin's outperformed most equities, and gold's generally been much better to hold than most bonds, especially sovereign bonds over 5+ years and counting. Longer term, depending on what starting point you want to go with. But basically, I think this is an environment where you continue to want to own scarce assets and notably want to hold scarce assets that are the best in class for whatever it is
Hmm.
that they do, and that they're not getting diluted in market share by other things. So if you own equities, you want to own the best ones at reasonable prices. If you want to own, crypto, you want to own the best and biggest self-sustaining network effect, in my opinion.
Interesting. What about stable coins? I mean, Tether's U.S. Treasury holdings now total about $84 billion, putting it among the largest buyer of government debt worldwide. I think it was former Speaker Paul Ryan even suggested that stablecoins could kind of finance the deficit. Does this enhance market liquidity or simply just add another fragile layer to the system?
I view it as it's a useful addition to the
Right.
instruments that people have to own dollars. I've been on the record as being bullish on the amount of stable coins proliferating since early 2021.
Hmm.
Meaning that it's not really an investable trade because like unless you're the issuer, because stable coins are pegged to a dollar, but they have market implications globally. One way to think about it is that for decades wealthy people had access to offshore bank accounts. And this is relevant in a world of, 180 different currencies, most of which debase very quickly and pegs break and inflation happens and authoritarian governments can seize assets. So all these kind of wealthy entities could have offshore bank accounts, and stablecoins are basically offshore bank accounts for the middle and working class. It
Right.
uses technology to compress the overhead, and it makes it easier to access custodial dollars and also use them as basically a checking account in dollars for those that don't have access to American banks or other developed market banks like Europe, Canada, these types of places. And so, Africa has 40 plus currencies. Imagine all the cross border frictions of trying to trade. Latin America has something like 30 plus currencies. Again, all the cross border frictions. Most of those currencies don't retain their value for very long, and so stablecoins are a way to access dollars globally. They basically digitize part of the Eurodollar market. So I don't really view them as necessarily adding fragility,
Right.
nor do I view them as a panacea for funding the government treasury. Though I guess the one caveat I would add is that as we see a little bit of top-down de-dollarization, meaning that, say, foreign central banks are not holding treasuries and buying treasuries at the rate that they used to, you still don't generally see any bottom-up de-dollarization. So
Right.
people in a developing country, if they want to hold a fiat currency for 3 months or 6 months for working capital, it'll generally be the dollar. And the stable coins allow a little bit more buying pressure because they can access them easier than they can access potentially other dollar instruments.
And do you think, could stablecoins actually extend the life of the dollar by absorbing demand from these emerging markets and kind of digital platforms, or are they just delaying the reckoning?
I would say that it can mildly extend the runway just because
Mm,
anything that makes it easier for the globe to buy dollars potentially increases the longevity of it. But that comes with the caveat that you generally need the problem is that so to some extent they're competing with the sovereign issuers of other currencies. So let's say you're a Nigerian, you don't really like the local currency, you hold, that's a country with pretty high levels of adoption of things like Bitcoin and stable coins.
hmm.
Bitcoin's volatile, so while you probably want to hold it for years, generally speaking, you can't necessarily rely it for your short-term capital needs, so you might hold some stable coins. And so because they're holding potentially stable coins instead of their local currency, that can fund the dollar and the treasury a little bit more than if their central bank held it. And that's largely because the central bank is basically in Nigeria, it's like almost like a fractional reserve entity. So central banks around the world, they hold generally some dollar assets, but only as a percentage of the money that they issue. And they use that to kind of try to sustain the value. Whereas stablecoins in the current era are generally fully backed.
Hmm.
And so you're getting more one-to-one exposure to the dollar. So around the margins, as people get out of the local currencies and try to hold some stable coins, it does to some extent extend the dollar's kind of dominance compared to other fiat currencies. But
Right.
right now we're talking about a $250 billion market in a sea of trillions of dollars of capital. So I would say for these things to really move the needle, they do need to hit well over the $1 trillion mark. So I think that they can move the needle, but it's not like a necessarily a game changer in and of itself.
Right. Yeah. I mean, we're seeing it in front of the House right now. I mean, they stalled the Genius Act last week despite the bipartisan momentum. But I think it was Marjorie Taylor Greene. She called it a CBDC Trojan horse in a viral tweet. I mean, President Trump tweeted from the Oval Office last night that 11 House Republicans had agreed to move it forward. Is this the turning point for stablecoin legislation, or a warning sign that kind of CBDC style frameworks could emerge through the back door?
So I think we'll see how this plays out. I mean, one
Right.
notable thing about the Genius Act is it prevents stablecoins from paying yield,
Mhm.
which makes it harder for them to compete with onshore banks, which is interesting. Um, Stablecoins in general can kind of serve as a private sector CBDC. So instead of the government doing it themselves, they can just say, well, this other entity can do it, but then we of course have control over that entity. We can always, if we don't like how they're doing it, or they're not conforming to the regulations we've given, we could sanction them. We can effectively cut them off from the dollar and the treasury network,
Mm.
and otherwise make it very difficult for them to do business. Um, and so with that, they get surveillance capabilities. So historically, there's a lot of physical dollars that trade outside of the U.S. They're harder to trace. And stablecoins are generally more traceable and in some cases freezable. If they
Mm.
identify who's using a stablecoin and they prefer them not to have access to them, they can tell the issuer to do basically law enforcement and freeze assets. So it does in some ways have CBDC like properties. I wouldn't necessarily categorize it as the same thing. And
Mhm.
some of these things, the bills are so long and complex that you can slip in language that allows over time more actual CBDC type of technologies to be developed and potentially employed as well. So I do think it's important for lawmakers and other people to watch the language of these bills specifically. But in general, even as is, stablecoins as is are basically a way for governments, and particularly the US, to extend surveillance over anyone who uses its ledger.
Interesting. And what about like, where regulators pressure stablecoin users, banks, fintech firms into kind of acting as extensions of state monetary control? No direct issuance needed, just top-down influence through the pipes. Are we already seeing that happen? You know, I
Uh,
mean, if
yeah, I think we are. I think that
yeah.
basically, to the extent that stablecoins compete with offshore physical currency, it basically brings more of that unsurveilled activity into a realm that can be surveilled, which
Hmm.
is what the government on average would like most of the time, probably.
And if so, I mean, what does it mean for capital freedom? I mean, financial privacy, the ability to kind of opt out of those centralized systems, and even to press it further, if stablecoins are, co-opted or regulated into narrow frameworks, what's left as the on-ramp? Does Bitcoin stand alone at this point?
Well, I would say, yeah, Bitcoin is the longer term answer here. Stablecoins are an additional top layer on the whole fiat stack.
Right.
Bitcoin is a competing bottom level asset. It competes with Fedwire and central banks as its own unit and settlement network that can't be arbitrarily frozen or otherwise controlled. Now, across the full stack, there are privacy considerations, including on Bitcoin. Generally speaking, it's easier to be private the smaller you are. Because
Hmm.
privacy is very dependent on liquid privacy. Generally speaking, it's easier to get lost in a crowd if you're small, for example. And so, if there are entities around the world using VPNs and using stable coins and stuff, they're probably reasonably safe, especially if they're not doing something that would attract a ton of negative attention. There are various privacy solutions for Bitcoin. Lightning Network is relatively private. Chalmy eCash is a layer of payments that is built on top of Bitcoin. That basically resurrects 40-year-old privacy technology that used to be developed for fiat, didn't really take off, and you can actually it's actually much better on an open source foundation like Bitcoin. So there are long-term privacy solutions here. But basically, Bitcoin is the one that's not just kind of instantly freezable,
Yeah.
whereas stablecoins, just like a bank account, in many ways are.
Yeah, it's incredibly private. I mean, I'm thinking about these billions of dollars worth of Bitcoin right now waking up from these old wallets and kind of coming to power. No one knows who they're from. No one knows what's happening. It kind of goes to the case thesis of Bitcoin, if I'm right.
Yeah, I think so. Bitcoin itself is anonymous in the sense
Yeah.
that if you acquire Bitcoin and then send Bitcoin, there's nothing that links it to you. Now, because a lot of exchanges and brokers are KYC'd, they're semi-effective at tracing Bitcoin. But
Mhm.
especially as Bitcoin, if you look at the long arc of time, as Bitcoin circulates more, and if more merchants directly accept it for payment, all those payments become much harder to track. So in an environment where most people just buy from exchange and hold it, that's generally pretty traceable. But as
Right.
that circulates more, it gets harder to trace. And then especially as you use things like Lightning or Chalmy and eCash, those that are trying to surveil it certainly have their work cut out for them. But I think even privacy aside, what these technologies generally do is put the onus on those trying to seize it or block it.
Mhm.
So, for example, in many countries, you can just freeze someone's bank account before you charge them with a crime. Just because rule of law is generally more muddled. Whereas with assets like Bitcoin or to some extent gold, you have to take more action to either charge them with something or otherwise, basically physically confiscate the assets in question if possible.
Yeah.
And I think that's a healthy thing. Basically, there should be individuals. It's good for them to have various tools to make it harder to just with a stroke of a pen confiscate, liquid assets that they own.
Yeah, let's talk about custodial concentration for a second because Bitcoin ETFs have seen these strong inflows, but you voiced concern about structural fragility, especially with BlackRock and Fidelity dominating custody and redemption. Could this centralized concentration, pose a risk in a market downturn?
Certainly in terms of price action, like if you
Right.
have a very large entity that encounters some sort of deleveraging event, that could certainly affect price action. As far as the stability of the network, I don't view it as a risk, at least anywhere near current levels at this
Hmm.
time.
Hmm.
If you look in the past, I mean, Bitcoin used to be more centralized in its ownership. At one point, there were an estimated like 850,000 coins on Mount Gox, which is originally a trading card exchange. And back then, there was something like half as many Bitcoin because we're talking, 2012, 2013, before a lot of it was mined. And so they percentage wise held a much bigger percentage of all Bitcoin than ETFs and even MicroStrategy do now. And so there, anytime there's a pocket of concentration, that could, that means that a smaller number of individuals can affect price pretty significantly. But it's also important to remember that a lot of these assets, whether it's MicroStrategy, whether it's the ETFs, they represent the ownership of many, many shareholders and security holders. So
Hmm.
that even that is ultimately, unless the government were to directly intervene and take it in some way, that generally represents the will of millions of people, rather than just one person's decision per se. So I don't really view it as a concern. In addition, because Bitcoin's proof of work instead of proof of stake, it means
Yeah.
that large holders of an asset, they don't have the ability to censor transactions or otherwise impact the network in the way that you would if you were a very large holder in a proof of stake network. So I think Bitcoin's well designed enough to withstand at times very concentrated buying.
Yeah, we got this new trend. I mean, I know that you've heard about it a lot, this kind of corporate treasury move. We're seeing this new phase of crypto adoption. Bitmine now holds $500 million in Ethereum on its balance sheet. Peter Thiel's Founders Fund is a major backer of there. Is this just an anomaly? Are we entering a post-Bitcoin era of a, broader crypto native treasury strategy here?
I think it's natural that someone would try to do it with the second
Yeah.
biggest cryptocurrency, and it's somewhat inevitable. I generally continue to much prefer Bitcoin over Ethereum. I've generally made the case that while I'm bullish on Bitcoin and stablecoins, I'm not really bullish on other crypto assets, including Ethereum. At times it can have a bull run in a trade and play catch up, but in general, because it's kind of Ethereum's kind of stuck in the middle ground where it's not as viewed as being decentralized and secure and risk minimized as Bitcoin. It has this
Mhm.
additional complexity. It has changing monetary policy. We don't really know how many ETH are going to exist in 5 years. Could be more or less than we expect.
Mhm.
On the other hand, there are other networks that optimize more for scalability. And so Ethereum kind of finds itself in the middle ground of trying to justify itself as a long-term holding while also trying to compete with some of these faster networks that care even less about decentralization, and try to just make fees and look, other things as low as possible. And so I think it's best to stick to the best in class one, which is Bitcoin. I think that's the one that's um, institutionally sufficient to put in, major corporations and build ETFs around. But that doesn't mean that others won't have their time in the sun temporarily. I just think that long term, I'm not particularly bullish on the ETH BTC ratio.
Okay, interesting. I mean, somebody had to do it, as you said, right? First to market. I know earlier this month you told precious metals investors that they could buy 5% Bitcoin and go to the beach. I just got to ask, I mean, again, with the Kitco audience in mind, why that specific number and how should gold investors think about the Bitcoin allocation without abandoning their core strategy here?
So I put that as basically those who they're precious metals investors.
Yeah.
The most well-known one is probably Peter Schiff, who's been notably publicly critical of Bitcoin for decade and counting, while it had its tremendous price run. But it's not just him. There are many others that are out there, always trying to make the case against Bitcoin and making the case for precious metals. And my view is more like, if you just bought a small slice of it, you could generally forget about it forever because if it does keep going up, you're protected because you own it.
Mhm.
And if you end up being if the bears are right and it diminishes greatly in value, you've only kind of wasted 5% of your exposure on it. And I generally view that as a healthier strategy for owning these assets. I mean, like I said, I've been long gold and Bitcoin for many years, and it makes it really easy to you don't lose sleep over it because you have the physical surety of gold, which is always nice. There's a market for that. The downside is it's not very portable, and Bitcoin is this growing network effect, new communication protocol of value. It's got even less supply growth than gold. It's got self-reinforcing network effects. You can send it to people very easily. Like if you were to hold a QR code up on this call, I could give you Bitcoin. I can't give you gold in any sort of
Mhm.
direct way without credit. And so they're two different asset classes or two different assets that kind of compete for similar but not identical markets. And I think they're both valuable.
Yeah, and it's not too late to get in here at 120,000. I mean, do you got a price a little bit of an overview for us, an outlook?
So I don't have a near-term price target. I don't think that this cycle is over yet. So I
Okay.
think we're going higher this cycle. I don't know if that means 150,000. I don't know if that means 200,000. I wouldn't try to guess.
Yeah.
At any given time, I'll assess market conditions, levels of euphoria, warning signs, or bullish signs. I'm still not too concerned with the end of this cycle. Longer term, gold is something like 2% of global assets. So, there are various wealth reports by investment banks to try to categorize how many assets are in the world. It's somewhere in the ballpark of a quadrillion dollars worth of assets. So, 1,000 trillions worth of assets. That's equities, that's bonds, that's currency, that's real estate, that's gold, that's fine art, it's Bitcoin, and these things like that. Gold at something like a $20 trillion market cap, now a little higher. That's around 2% of global assets. And Bitcoin is something like a tenth of that, so that's about 0.2% of global assets. In general, I think that gold's probably headed higher than 2%, and I do think that Bitcoin can play catch up and eventually, breach 1%, and then probably eventually get into multiple single percentages, which we start from a 0.2% base is obviously pretty bullish. So I do think that in the long arc of time, seven-figure Bitcoin is not unreasonable. I wouldn't call for it in the near term, however.
Yeah, yeah, you're not the only one. Before I let you go, our time always goes too fast, but if we zoom out a little bit beyond this week's headlines, rate policy, legislation, we're watching kind of a slow motion regime shift, fiat dilution, structural deficits, digital asset infrastructure. We got these liquidity driven markets. For investors that are looking to that long term, building wealth and preserving optionality, what do you believe is the single most important macro truth that they need to understand now before the next phase begins?
Probably the biggest macro thing I follow is the structural U.S. fiscal deficits and how intractable they are. And the fact that the current system designed such that total credit can't really stop growing for anything more than like a year before things really start breaking. And so with that backdrop in mind, that's the investing backdrop you're working with. I would say in the more cyclical sense, for me, by far the biggest headline to monitor is tariffs. And the reason for that is part of the large fiscal deficits, part of not the only reason, but part of why they're so hard to reduce is that there's a lot of congressional polarization around either cutting major areas of spending, so Social Security, Medicare, defense, veterans benefits, interest expense, obviously very challenging. So, and that represents the vast majority of spending. So there's all these kind of things against spending cuts, and then there's also multiple defenses against tax increases. Most Republicans would not vote for significant tax increases, for example. And so when you have that combined, it's very hard to address the deficits. The biggest lever right now is that because Trump is using emergency, like national security justifications to do basically emergency powers for tariffs, he's able to bypass some of that gridlock with effectively what could be the biggest tax increases in modern U.S. history. And so that is the headline to watch because, like I said earlier in this talk, I mean, if there's no market event, meaning a negative kind of volatility move and some temporary sell-offs, then the president has every reason to kind of keep pushing hard on those tariffs. And yet, if there is a market event, that there's probably some degree of retracement and delays and things like that. But I wouldn't necessarily just look forward through that, especially if you're managing any sort of investments that you'd be concerned around volatility or otherwise. I think basically right now the biggest structural thing is nothing really stops these deficits. But if there's something that temporarily slows it down, it's tariffs.
Interesting. Nothing stops the train. All right, Lyn Alden joining us today. Thank you for your time. We always appreciate it. And I look forward to talking to you again soon. We'll see how this all plays out.
Thank you.
All right, that's Lyn Alden cutting through the noise and connecting fiscal dominance, stablecoin infrastructure, Bitcoin's macro positioning, and of course, the new rules of capital allocation. Now, you can read more of her work at lynalden.com. Don't forget to subscribe to Kitco News for more high-impact interviews and follow us right here on YouTube and all other major platforms. I'm Jeremy Szafron. Thanks for watching.